In this week's video, we'll cover a fatal investing mistake that typically comes into play during the course of a calendar year, and it appears to be playing a role again in 2018. Since we'll be expanding on themes we've covered in recent videos, we'll be moving very quickly in the first segment of this week's video. If we jotted down some investment goals on the back of a napkin at first blush, these all appear to be relatively prudent. I want to make money. I'd like to avoid volatility, or at least reduce volatility. I'd like to feel comfortable that there's some downside protection. I'd like to protect my capital, and I'd like to beat the stock market. After we walk through several calendar years in the stock market, we'll ask ourselves, are these reasonable and prudent goals? This is April of calendar year 2003. This is a downward sloping 200-day moving average. Price tries to exceed the 200-day on two occasions, and then it fails. We know humans like to extrapolate. It'd be very easy to extrapolate in this direction. What happened next? For the full calendar year, from point A to point B, the S&P 500 gained 26.38%. This is the first 8.5 months of calendar year 2004. We've got a series of lower highs and lower lows. Price makes a pretty convincing move below the 200-day moving average, goes back up, tries to retake it, and bounces off in a bearish manner. When we're down here, emotions most likely are running high, and it's very easy to extrapolate. We know what's going to happen next. And we know from last week's video that extrapolating can be dangerous. The stock market didn't go in this direction. It rallied strongly and recaptured an upward sloping 200-day moving average by October of 2004. And as always, we want to extrapolate. We know what the rest of the year is going to look like. What happened next from early October 2004? The answer is price dropped in the other direction, below a 200-day moving average that appears to be rolling over. In October of 2004, the market was red year to date. This is where it started. We're now below it. Now the shorter term data that we have makes it very easy to flip again and say this is what the rest of the year is going to look like. What happened from mid to late October? Rather than rolling over from mid to late October, the market rallied strongly into year end and produced a point A to point B gain for the entire calendar year, a very satisfying gain of almost 9%. If we tried to protect capital and we were watching the markets too closely, it would have been very difficult to navigate from point A to point B. And rather than protecting capital, when we have a whipsaw city situation like this, the odds favor destroying value in this area here by trading rather than protecting capital. And if I'm out, I'm in, I'm out, I'm in, I'm out, I'm in, I'm out, I'm in, I'm out, I'm in. At the end of the year, instead of having roughly a 9% gain, I might finish the year up 2% or maybe even down 2%. That doesn't sound too bad, but when we compare it to the 9% gain for the S&P 500, that's a pretty significant difference. Similar situation, 2005. We have somewhat of a dicey situation, but it looks like an upward sloping 200-day moving average is held. We cleared this previous area of resistance and could make an argument that we have a bullish cup and handle formation here, and we're breaking above the rim of the cup. Humans like to extrapolate. We know how the rest of the year is going to play out. What happened from early August? As you might have guessed, we went in the opposite direction. And with price now below a 200-day moving average that's rolling over, our outlook might have flip-flopped once again. And from this point, things look pretty grim. From the third week of October, what happened next? Stocks rallied into year end. If we focused on the primary trend and made no trades between point A and point B, hypothetically, our gain would have been 3%, which doesn't sound very impressive. But if we're trying to trade frequently between point A and point B, and we're watching the market too closely, this type of volatility could produce another we're out, we're in, we're out, we're in, we're out, we're in type scenario. And instead of having a gain of 3% at the end of the year, these whipsaws start to add up. And even though the market was positive for the entire year, the year was very, very difficult. And once again, inside of the orange box, in the real world, the odds favor destroying value in the orange box rather than protecting capital. And with this type of volatility and with multiple whipsaws, drops below the 200-day moving average, if we're trading frequently and watching things too closely, instead of posting a 3% gain, we may have seen something like a 2% to 7% loss. 2% loss doesn't sound that bad, but you're lagging the overall market by 5%. 2006. This is a strong trend. We know what's going to happen next. From early May, what actually happened next after price broke out of this short-term consolidation box here. Once again, extrapolating and forecasting didn't work out real well. Price dropped below the 200-day moving average. The 200-day looked like it's starting to flatten out. It would be very, very easy for a human being. We all do it. We have a tendency to extrapolate. We know what's going to happen next. What actually happened next from mid-June? Price rallied strongly, made somewhat of a double bottom formation here. This is a bottoming formation and a breakout. The gain from point A to point B for the full calendar year was a very satisfying 13.62%. But with countless jumps above and below the 200-day moving average, depending upon your system, 2006 might have been very, very difficult. And if we're watching things very, very closely, tick by tick, every single day, every single hour, if we're looking at our account balances frequently, this is the type of volatility that we would have seen between point A and point B. A lot of givebacks, a lot of drawdowns, some of them significant. Even in a year that has two periods marked by relatively strong trends, this is not easy. 2007, price comes down, makes a stand above an upward sloping 200-day moving average. We have somewhat of a breakout look here with price making a new high. It'd be very, very difficult to look at this and interpret this as bearish. We'd have a tendency to interpret it as bullish and extrapolate. There's a reason why we have the term failed breakout. In the third week of August 2007, we're negative year to date. We're below the 200-day moving average, which is flattening out, and things are looking pretty dicey. As you might imagine, stocks rallied into the peak in October of 2007. The gain from point A to point B was 10.35%. If we were trying to trade between point A and point B, not particularly easy. Here's a breakdown, a bearish breakdown, a lower low, a lower high, several moves above and below the 200-day moving average. As we walk through these charts, it's important to note our purpose here is not to describe how the CCM market model works in the real world. Our purpose is to understand how markets operate in the real world. If we want to successfully navigate between a point A and a point B, we have to understand what we're up against, which is how do markets operate. And to illustrate some basic concepts, let's assume we started with $1 million heading into calendar year 2003. Hypothetically, if we held between point A and point B, our $1 million would have grown to $1.2 million at the end of the year, and we could have done that with 0 trades, making the assumption that we already are in at the end of 2002. If we fast forward to the next year and carried our 1.2 million into 2004, if we were able hypothetically to focus on the primary trend and navigate between point A and point B, we could have made 0 trades between point A and point B, and our $1.2 million would have gained 8.99%, and we would have had 1.37 million at the end of the year. If we carry this into the next year, and focused on the primary trend, and we're able to hold between a point A and a point B, 1.3 to 1.4 at the end of the year. Remember, a 3% gain does not sound that impressive, but you have to look at it in this context. If we were watching the markets too closely or trying to trade frequently, there's a high probability with this type of volatility that this 3% gain would be lower, and most likely it would be negative. So this number would drop in a year like this. We're talking in general terms here. It's a well-documented fact that most traders lose money. We're trying to understand why that's the case. The short answer is markets are extremely difficult. If we carried the 1.4 million into calendar year 2006 and focused on the primary trend, we would have had 1.6 million at the end of the year, and I could have made hypothetically 0 trades between point A and point B. If we took 1.6 million into the next year and focused on the primary trend, our 1.6 million would have grown to just under 1.8 million. I could have gained 10.35% by making no trades between point A and point B. And think about if you were sitting in front of a terminal watching the market tick by tick during this year and watching your balance fluctuate and always managing off of your all-time high balance. In retrospect, this might not look pretty hard, but on closer inspection, there is a ton of volatility between point A and point B. A point A and point B move that produced a gain of 10.35%, and it didn't require any trades to capture that gain. And if we're thinking about protecting capital, I have to protect capital, I have to protect capital, I have to protect capital. One thing we always have to remember, if we get out, we have to get back in. And that can produce a lot of trading, a lot of whipsaws, a lot of emotional swings, and a lot of discouragement. Again, we're talking in general terms here. We're not talking about anyone's specific strategy. Like anything else in life, there are a small percentage of traders that are very, very good at navigating between point A and point B while having a shorter term focus. The vast majority of traders are losing money between point A and point B. So what's the moral of the story here? The moral of the story here is that whenever possible, we want to try to focus on the primary trend, because we're acknowledging in advance that a typical calendar year in the stock market is no picnic or no walk in the park. And all things being equal, a lower trading frequency between point A and point B is better than a higher trading frequency between point A and point B. Now, as we slip over to the next slide, should be noted, this is a chart for illustrative purposes only. Went out and arbitrarily picked 2 monthly moving averages to illustrate basic concepts. There's no value in going back and trying to figure out what moving averages these are. These are not used by the model. We're not showing these for timing purposes. We're showing them to demonstrate that for the most part, between point A, when I had $1 million, to point B, there was not a lot of evidence that told us the primary trend had flipped over. And these 2 moving averages simply help us illustrate that basic concept. Under our approach, between point A and point B, we would be looking at the weight of the evidence on multiple time frames, using multiple inputs, using indicators, asset class behavior, and risk-on, risk-off ratios to determine what's the probability that the primary trend is still up, and what's the probability that the primary trend is rolling over. Think about all of the volatility we walked through between point A and point B. It's pretty easy to see using this for illustrative purposes only concept. This, where blue for the most part is on top, the faster moving average, and the slopes of both moving averages for the most part during a multiple year primary trend move looks drastically different from this. And again, we're using this to illustrate basic concepts. We wouldn't be using this as a timing signal. This is more of a confirmation signal. If we believe over here that the primary trend is down, this type of look here might not be helpful mathematically, but it can help us confirm that the primary trend still appears to be down. Conversely, using these two moving averages between point A and point B mathematically might not be particularly helpful, but they can help us confirm if the weight of the evidence is saying the bias is still to the upside. Something like this would align with that. So given what we've just reviewed, that it's possible hypothetically to invest $1 million, make 0 trades for this entire move, and have roughly 1.8 million at the end. The extreme example helps us illustrate that you don't have to necessarily trade a lot between a point A and a point B to produce very satisfying returns. And if we zoom in a little closer, there's a ton of volatility in a typical calendar year, and it's very, very difficult to trade intra-year. If we link back to the original back-of-the-napkin goals, now that we have a better understanding how markets operate, they're very, very difficult. Are these reasonable goals? From a simplified perspective, I think you can make an argument out of this list here when the primary trend is clearly up. The only real productive goal on this back-of-the-napkin list is the goal of making money. If our primary goal is not making money, we should not be anywhere near the stock market. When the primary trend is clearly up, it is counterproductive to try to avoid volatility. It's counterproductive to even try to reduce volatility. It's counterproductive to have a goal of feeling comfortable. Even the concept of protecting capital is noble, but it tends to lead to overtrading. And when the primary trend is clearly up, you can also make an argument that beating the market is counterproductive. Why? Because like all of these bullet points, trying to beat the market has a tendency to lead us to over-trading. And we just saw how difficult it is to trade. Over-trading typically won't help us make money. It will help us lose money. And the other important takeaway, obviously we head into every year with a goal of beating the market, but why is beating the market not nearly as important as focusing on the primary goal of making money? Because you can produce very, very satisfying returns by just staying near the market between a point A and a point B. So even if you underperform here because you're managing risk sometimes between point A and point B, if you err on the side of staying with the primary trend and capture a significant portion of a 229% move or a significant portion of a 582% move, unless we're greedy or unless our ego is involved, no one should be unhappy with returns of this magnitude. And you don't necessarily have to beat the market to get very, very satisfying gains over the long haul. And while a goal of beating the market seems noble, often the overtrading leads to significantly lagging the market over the long haul. Hypothetically, if we invested $1 million on the lower left side of this chart, when we get to the upper right-hand corner, if we had a 229% gain, our $1 million would be worth $3.2 million. Over here, $1 million investment held from point A to point B, hypothetically, would have grown to over $6 million. These are very, very satisfying gains. And even if you underperformed and captured a significant portion of these gains, they are still very satisfying. How about in the situation where the weight of the evidence tells us that the primary trend is bearish? If the odds are clearly against us and the odds of making lower lows, those odds are more favorable than the odds of making higher highs, then absolutely, a reasonable objective is to protect our capital. We do want to reduce volatility if the stock market's going to fall 50%, and we can still think about making money during secular bearish trends because defensive assets can make money. And in this case, we do want to beat the market. If the market falls 58% between a point A and a point B, it's extremely important to beat the market in this environment. Because in this case, market returns would not be satisfying at all. So our goals are different over the full market cycle, and they shift. One common theme when the trends are strong and long term is our primary objective has to be to make money. If it's not, it's going to be very, very difficult to make money. And if our primary objective is to avoid volatility or to feel comfortable, it's going to be very, very difficult to make money. Moral of the story, volatility is not the enemy. It is a normal part of all trends, and no system or approach can alter that fact. We can build systems that will avoid volatility and make us feel comfortable during the calendar year. The only problem is they have a very low probability of making money between a point A and a point B. Takeaway number 2, it is not possible to make money in the stock market without feeling uncomfortable from time to time. Even strong trends, if we're staying with the primary trend, we're going to feel good, we're going to feel bad. Good, bad, good, bad, good, bad. That's just a normal function of how markets operate. So having goals that talk about avoiding volatility or feeling comfortable, they just don't make sense. You can't change the stock market. It's simply not possible to make money without feeling uncomfortable from time to time. We know that before we start. And when we understand how markets operate, we understand we have 2 basic options. When the primary trend is clearly up, does it appear to be easier to try to minimize trading between a point A and a point B? Or does it appear to be easier to try to trade frequently between point A and point B? When the primary trend is up, does it appear easier to hold between point A and point B or try to trade in and out frequently? Easy calendar years in the stock market are the exception to the rule, not the rule. It's not unusual to go below a 200-day moving average. It's not unusual to turn red year to date and then finish the year green. In fact, it's quite common. These concepts also apply to secular bearish trends. Since counter-trend moves are a part of all trends, it still doesn't make sense to have an objective of avoiding volatility or feeling comfortable. Why? Because even though the stock market is clearly in a primary downtrend here, we know that we're going to have counter-trend moves. So if we're invested in the bullish primary trends here, which are in defensive assets, let's say treasury bonds, typically when the stock market has a normal counter-trend move, we're going to feel uncomfortable owning defensive assets. And even in this instance, when we're invested in defensive assets, volatility is not the enemy. It is a normal part of all trends, and no system or approach can alter that fact. It's a fact. So in this environment, it is productive to protect capital relative to the stock market. It is productive to try to beat the stock market. It is productive to try to reduce volatility relative to a 50% drop. And in this case, in a secular downtrend, a clear downtrend, a strong downtrend, money can be made in defensive assets. But if we want to try to beat the market in the downtrend and we want to try to make money, it's not possible to have these as primary objectives or frankly objectives at all. Feeling uncomfortable is part of investing in the financial markets, period, end of story. And when we review the market and we understand how difficult it is to navigate from a point A to a point B in a typical year, we understand why this list of common missteps is so important and why it applies to the real world. And the charts that we've just reviewed underscore that traders and investors typically greatly underestimate in these two key market areas. They greatly underestimate how frustrating, volatile, and difficult the markets are, and they greatly underestimate the power and strength of primary trends. And they greatly underestimate the power and strength of primary trends. We've just shown that when the primary trend is bullish and strong, it's very, very difficult to avoid volatility, reduce volatility, to feel comfortable all the time, protect your capital, and or beat the market. If that's the case, then why do so many investors have these as primary objectives? And that takes us to the moral of the story and our fatal misconception. The fatal misconception for most of us when we enter the markets is we have unrealistic expectations about how markets operate in the real world. We have unrealistic expectations about volatility. And many people have very unrealistic expectations about the benefits of diversification. And if you're skeptical about this bullet point, visit the FAQs on our website. And when we have unrealistic expectations and we add in unrealistic objectives, it's going to be very, very difficult to make money. And if we can't make money, then we have to question why we're in the markets. After reviewing the charts that we've just reviewed, it's pretty easy to say that the answer to the question, are markets easy, is no. Markets are very difficult, which is exactly why it can be extremely powerful to simplify by focusing on the primary trend and long-term probabilities. The purpose of this video is not to focus on how we do that. The purpose of this video is to define the problem. Why is it so difficult to make money in the stock market? Because most of us come to the market with very unrealistic expectations about how markets operate in the real world. It's been 76 days since the S&P 500 peaked in 2018 on April 13th. Friday the 13th, 76 days after the peak. This is the look of the intermediate term trends, the 110-day out to the 130-day simple moving averages. These are daily moving averages for illustrative purposes only. These are the exact same moving averages 76 days after the stock market peaked in 2007. If we zoom in a little closer, this is the morning of Friday, April 13th, during the trading session, we can see that for the most part, all of these slopes are unequivocally up. That's a fact. And instead of having a turn down or flattening outlook here, a turn down or flattening outlook, if anything, we have a look of turning back up. This is a 1 month period. So we can ask, does this 1 month period, 76 days after the peak, look anything like this 1 month period, 76 days after the stock market peaked? We could see this, measure it, put it in a model after this really bad things happened in the stock market. Why is this relevant? We're not forecasting with this. We just went over it. Extrapolating these lines is dangerous because we know with 100% certainty, if we're going to have another financial crisis, a fall in the order of magnitude of 30 to 50%, something that could last 16 months to 2+ years, we know with 100% certainty, if the market's going to fall that far, these moving averages will not look like this. Eventually, they will roll over. And that may happen. That may be in the process of happening right now, but it hasn't happened yet. And that's why we take it day by day and have a flexible, unbiased, and open mind about what's going to happen next, including the look of these moving averages. If you were wondering if the previous chart from intraday on April 13th changed between roughly 10 a.m. and 4 p.m., the answer is no. Exact same chart as of the close on Friday, April 13th, 2018. As we mentioned in last Friday's video, we closed a week ago today near an inflection point. Over the last 5 sessions, the S&P 500 gained almost 2%. Friday's session was down 0.29%, which basically says it was a 100% normal and to be expected day. Nothing particularly noteworthy about Friday's session. We finished the week on Friday, April 13th, 124 points above the lower end of the range. And as of the close on April 13th, we still have not completed step 3, and that's to be determined. Basically, everything that we said last week about the range still applies. We really didn't learn too much one way or another over the past 5 trading sessions, and the market is still vulnerable if it wants to come down in this area here. As always, we'll take it day by day with no preconceived notion as to what will happen next week and the weeks after that. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.